welcome everyone. Thank you for joining us today. I'm really excited about this series of events we're going to be hosting with Joe, the Homebuyer Coach. The reason I'm particularly excited is because when it comes to the whole challenge of buying your first home, I think you need two kind of key areas of expertise in your pocket. Those who kind of really know financial advice, all the things around saving and tax wrappers and all the foundations around putting a plan together, as well as people who know all about mortgages and the latter stages of home buying. And that's really what Joe is going to be helping a lot with as we go through these series of events. Just to introduce everyone today. So as I mentioned, Joe is the Homebuyer Coach. He's been involved with kind of financial services over the last 14 years or so now. Gosh, you're still looking very young, Joe, I must say. And over the last year or so, he's been slowly becoming a total kind of social media rock star. So I've really been enjoying a lot of what he's been putting out on TikTok and Instagram. And really that's his way of kind of going on this kind of mission of helping educate new buyers, helping them understand the complete process of buying a new home, all the way from starting to put a deposit together all the way through to collecting the keys. And we really kind of enjoyed putting this kind of series together with him. And he bought his first property in 2017, so not that long ago. I'm also going to introduce Peter. Peter is our head of advice at Multiply. He brings so much wisdom to kind of what we're doing every day. He spent 26 years in the industry, so a very long time. 26 is also the average age of our first-time homebuyer cohort. So he's been around for quite a while. And he bought his first property back in 1994. And he really kind of helps us put all of the kind of advice that we put out through our app together. We've also got Dan. Dan is going to be kind of manning the kind of Q&A today. So whenever you've got any questions you want to be asking, feel free to put them in the Q&A channel, and we'll kind of answer them as we go along. He's had 15 years of experience in the world of financial advice and bought his first home in 2014. And then there's me. So I'm going to be introducing the event today and a couple of slides as we go through. And I'm the co-founder and CEO of Multiply. Multiply was founded to help people achieve their financial goals. We spent a number of years now automating holistic financial advice and making that available to as many people as possible. And my background is also in finance, but I've only been a financial advisor for a few years. Prior to that, I spent 12 years in the world of banking. Right, so what are we going to be running through today? So today is all around the foundations. It is the first of a series of 5 webinars, workshops we're going to be hosting. Such that from start to finish, everyone will learn everything you need to know about the home buyer process and approach it like a pro. Today specifically, we're going to be covering 3 main areas. We're going to be kicking off with just kind of the whole topic of whether buying is right for you. It's likely the biggest purchase of your life. It's a huge commitment. It's going to take a long time for people to kind of achieve. And Peter's going to be running through that section. We're then going to be passing over to Joe, who's going to be running through the whole home buying process from the very kind of beginning all the way through to the point where you get keys and all the kind of different rungs on that kind of ladder as you go through as you go through the process. And that's going to be split in 2 main parts, like everything before you make an offer and everything that comes afterwards. But we'll also be signposting the upcoming events as we go through that, so you'll know which kind of events in our series will be most relevant to you. And then finally, Peter and I will be running through what you need to be thinking around to get ready for the journey, kind of financial foundations you need to put in place such that you are really set for the whole journey and you kind of build resilience as you go through. And we're planning to get through all the content that we prepared today in around 45 minutes, such that we leave 10 to 15 minutes at the end for Q&A. Right, on that note, Peter, over to you. Is buying right for you?
Okay, hi everyone. Just one extra bit of sort of housekeeping. If people have got questions as we go through, could we try and add them into the Q&A channel rather than the chat channel itself? So that way we can keep a control over it and make sure that basically we answer your questions. So that would be great. Okay, so Vivek, if you could just move on to the next slide. So I guess the starting point with this is that just to dispel a couple of myths. Now, I'm the first to recognise that probably most of you that have logged in to watch this today have made a conscious decision that you're looking at buying your first home, and that's absolutely fine. But what I do want to make sure is that I just cover off a few of the bits that I've seen over the years where actually buying isn't for everyone. And really just to dispel a couple of myths. And the first one, I guess, is people say you can't lose. And I've seen that on TikTok channel. I've seen it specifically there, you can't lose. I can assure you that you can. I've seen people who have lost for a number of reasons, and some of them are fairly obvious. So, for example, you buy a home and then maybe, unfortunately, you've lost your job, and therefore you haven't been able to maintain payments and the mortgage lender has ended up taking a home back. That's a scenario where somebody could lose. I think it's worth just pointing out at that point, mortgage lenders, that's their last resort. That's not what they want to do. So, you know, I don't want you to be worrying about it, but just to be aware that people do lose. I also know that people who have bought new homes, if you buy a new home, it's a bit like sometimes buying a brand new car. I mean, the moment with a car, you pick it up, you drive it off the forecourt, and you've probably lost a couple of thousand in the first 200 yards. So it's probably worth acknowledging that what comes with a new home is that you usually get a warranty and you've got the snagging and people will come and fix things. But it does actually come at a bit of a cost, or quite often comes at a bit of a cost, where sometimes the house price after you've first bought can drop a bit. That's not to say it always does. I'm just saying that sometimes it does. Right? And another scenario that I'd just like to point out is a personal friend of ours, my wife and I, who they bought a property, cost them several £100,000, and they bought it, and it had a lovely view across fields going across part of towards Sandwich in Kent. And within 18 months, planning permission had been approved for a new 1,500 home site of development to go in that basically was their view. And it was gone, and the value of their property dropped by about 200,000, and it's taken them 15 years before it's actually grown back up to the value that they actually paid for it. So it's worth just bearing these things in mind. It's not a certain that you will always win with property. Okay, sometimes it can actually be better to be renting rather than owning. That's the fact of it. Right? Another thing that people often say to me is, oh, it's a great investment. Now, if you're talking in pure value of a property at one point, and then you take X number of years moving forward, it's grown, then yes, you can argue from a monetary perspective, it is an investment. However, you shouldn't really see it that way, because you're buying a home, somewhere where you're going to live and grow memories, and that aspect to it is more important than the numbers. So don't buy off the back of what numbers tell you. You should be thinking more about what you want from a home perspective. It's also worth knowing that you've probably got to live somewhere. So it might be an investment that's grown in value, but it's probably more likely that it will be the beneficiaries of your will, maybe, who are going to actually realize any benefit of it rather than yourself. Again, there are exceptions. People downsize as they move into retirement and realize value. So I'm not saying it's an across the board rule, but just be aware that see it as your home rather than as an investment. Okay. And there are some really big, important questions that you've got to take on. And to me, I mean, they're listed here. I'm not going to repeat them all, but I will just draw your attention to the fourth one down, which is, do I want the responsibility of a large long-term debt? Okay. If the thought of having a 100, 200, potentially 300,000, 400,000 £400 debt is going to keep you awake at night, then you might want to think twice about whether it's right for you or whether it's right for you at this point in time. I can assure you 25, 30 years worth of not being able to sleep is probably not going to do much for your health in the long term. Okay, so there are some core bits that are worth bearing in mind there. But I think it's also worth just understanding or just going through the plus points and negative points of both owning versus renting. So maybe Vivek, if you could just move the slide on.
Yeah, Peter, just before that, Dan just flagged up a question that came in from Ben to answer live, which is, are we currently in a housing bubble? And if so, would it be better to wait for the market to collapse? I don't know whether you want to answer that, or Joe, or anyone else on the panel.
Well, I'll give my view, and then maybe, I don't know if Joe, if you've got something you might want to say as well, but yeah, sure. Are we in a housing bubble? The short answer is, I don't think even the absolute experts know this. Okay, there was the Bank of England themselves are monitoring very closely what's happening with the housing market, because they're not sure whether this is just a housing bubble that is a bit of a wave because of the COVID implications, or if there has actually been a fundamental shift in the property market, the habits of people, and impacting the longer term property market. So if the experts on the Monetary Policy Committee don't yet know, I'm afraid I've got to put my hands up as well. What I do feel is that there's probably a bit of both going on. You know, that there is a bit of a bubble or a wave because of the COVID restrictions that have happened. I think people are looking at home buying in a slightly different way compared to how they were before. So there's probably somewhere in between. Would it be better to wait for the market to collapse? There are so many different variables there. If you are looking at buying in London, and all of the trends are saying people are looking at moving out, well, you could argue that, well, maybe there's an element of waiting a bit longer. But if you're actually looking at buying in one of the areas that people are now looking at buying from, you can argue now's the time to go in before it goes up. So I'm sorry I can't answer it specifically, but what I can tell you is even the experts are waiting on this, because they will react accordingly. If they need to put interest rates up, they will. Okay, but they're not ready to doing that yet, and I can't see them doing that over the next couple of months or next couple of review meetings that the Monetary Policy Committee have.
Joe, anything you want to add on to that?
Yeah, I mean, really, we just have to kind of look at the stats, and anybody that is in a position where they're out viewing properties at the minute will know that there's a huge demand for them, and that values seem to have increased quite a bit. Now, I've had a couple of scenarios where offers have gone, you know, 20, 25, 30,000 pounds over the asking price. But what's happened in those scenarios is sometimes the lender has said, you know, we don't agree with the value that's been accepted there. So, you know, the lenders may have a bit of an issue. So I'd say we are in a bit of a bubble. There is a huge amount of demand at the moment, but it's very difficult to say exactly what's going to happen.
Gotcha. Cool, thanks, Jay. Shall I move on, Peter?
Yeah, no, please do. Yeah, just really wanted to cover off the owning versus renting, that there are plus points and negative points, and you really need to be fully committed to the route you're going and understanding the plus points and the negative points. And if we take owning, first of all, I mean, the obvious benefits predominantly of owning are the freedom that it gives you, the security that it can give you. You know, as long as you're keeping up your mortgage payments, you're safe where you are, etc. But it does come with a commitment. And that commitment is the mortgages aspect itself, as I mentioned before. But there's also, it's worth pointing out, if people are buying as a couple, it sounds horrible to say it, but I've seen it time and time again, unfortunately. And that's the downside part of the job sometimes, is that if relationships break down, if you own a property together, that can get messy. Okay, so you just got to bear that in mind in terms of your commitment towards it. And the beauty with that is that if you're still in the saving up stage, well, you've got time to see that panel. You don't, you know, that doesn't necessarily need to be oh, I don't think my relationship's going to work. You don't need to do that, but it gives you time to, as you feel that. Okay, costs. DIY. If you're not DIY inclined, then you're going to have to probably bear in mind that you'll be hiring tradesmen in to do certain jobs. For other people, it might be, yeah, I'll have a go, and you know, and that's fine, and then you save money. So it's just being aware of that there are plus points and negative points. The big benefit when it comes to the renting side is the flexibility that you have. Okay, you may be able to rent somewhere that you know you'll never be able to afford, and I've seen that as well. It's relatively simple. It's a relatively simple process in terms of renting and moving from one place to another. It's pretty straightforward. Negative points, you're subject to contract, you know, and where you have if you're buying, you've got a mortgage contract. With this, you've got a rental agreement, and it could be quite restrictive. I've seen them where, you know, simple things like putting up television, you've got to get the landlord's permission for. Okay, there could be other restrictions. For example, they might not allow children, or they might not have pets. Okay, the big obvious downside to renting is the notice period. You know, you've always got that potential that your landlord is going to say, actually, I'm either thinking of selling, or I don't want you to be here anymore, and they put your notice in. So there are these owning and renting. The stress, the bit that I think I would stress as a matter of this is, be patient. There isn't any, there's nothing here that is saying you have to make an outright final decision on whether you're owning and renting until you decide to actually go out and start start looking at the properties that you're going to buy. And even then, it's not until you commit. Okay, so be patient. I think that's the bit, the message with this. Be aware of the pluses and negative points that go with it. Okay, and I think on that point, I think it's probably good for me to hand over to Joe now, who I believe has got a question that he wants to start off with. So I'll hand over to Joe.
Thanks, Peter. Yeah, so I'd like to kick off with a question. So what do you think is the average age of a first-time home buyer in the UK? If you could, give your answers. We'll give it around 30 seconds or so. I did a similar quiz on my Instagram page, and some of you may remember the answer. The answer's actually gone up since I did that. Yeah, we'll wait and see what your answers are.
We've had around 70% of people answer. We've got more
Cool.
through. You should be able to see a poll that's popped up. It should be in a little box for you to click on your answer. Right, we've had 80% of answers in. Nearly there. I'll give it 10 more seconds. There we go. Right. Let me end it. So the results are in, Joe. We've got 0% answering A, 24.
Okay.
We've got 35% of the answers came in at 27. 39% came in at 31. And 27% came in at 34. So quite an even spread between B, C, and D.
Okay, interesting. Well, the answer is 34. So which is a lot older than what many people think, including me. Before I did this, before I looked into this, I thought it was a lot younger than that. I think places like London do push up the average slightly. But I think the biggest thing to take away from that is just to be patient. You know, there's a lot of people in the same position as you. Buying a house is a massive decision, which does take a huge amount of planning, and it really can't be rushed. Something else that can't be rushed is the actual home buying process, which Vivek, can we go into now if that's okay?
Sure thing, yeah.
Great. So yeah, here we will talk through the home buying process. Now, this is kind of what I go through with the clients when I see them for a first mortgage appointment. Just so you know, we will be going through each stage in a lot more detail in future episodes. So yeah, let's have a look. So point one is set your target and save up. So after what Peter's been saying, you've made the decision that buying is right for you. This is where you need to make a plan and start saving towards your deposit. It's also worth noting that deposits don't always need to come purely from savings. You can have it from other sources. If you're fortunate enough to have family that are willing to help, they can provide things like gifted deposits. Point two is get mortgage ready. So when your deposit is in place and you're ready to start house hunting, it's time to get mortgage ready. So speak with a mortgage broker to find out realistically how much you'll be able to borrow and what type of properties you may be able to buy. I go quite in depth in my appointments with these kind of things. You know, we discuss things like credit rating, current levels of debt and how it can affect your affordability, the home buying process like we're doing now, different types of mortgages that are available, mortgage terms, so how long the mortgage is over, and lots and lots of other bits and pieces. Next, point three is get a mortgage in principle. So now you're in a position to start viewing properties, and this is where many people rush and kind of get it wrong. So it's best at this stage to obtain something called a mortgage in principle from your broker. This is a certificate based on an affordability assessment to demonstrate what a lender might be able to lend to you. It's also what a lot of estate agents ask before you make an offer on a property, so they'll ask to see a copy of your mortgage in principle too, especially now that the market's so heavy at the minute. You know, there's so many viewings going on. They want to make sure you're in a proceedable position before they tie anything up. Point four is find the right property. So there's many places to search for properties these days. Most popular tends to be things like Rightmove and Zoopla, social media pages, so estate agents' Facebook pages. They're worth looking at because they tend to get updated a little bit quicker than property websites, and directly with estate agents too. If you can register with local estate agents, that at the minute tends to be the best option, purely because they'll actually make you aware of properties coming onto the market potentially before they're even on. So that's the best place. Finding the right property, it's very difficult to find your perfect home, especially when you have a budget. So it's worth making a list of things that you may be able to compromise on, such as things like area and number of bedrooms, parking, that kind of thing. Point five is agree a purchase price. So this is kind of where things start to get a bit exciting. So you found your dream home and it's kind of like, what next? Well, you have to kind of negotiate with the seller to agree a purchase price on the property. And it can be quite stressful, especially if there's like a lot of interest. So it's best to do research before making offering. And knowledge is definitely power. So speak with the estate agent, find out, are properties selling quickly at the moment? What position is the seller in? Do they need to find somewhere? Is it empty? Was it previously let or rented? Knowing the seller's situation will give you an idea on how flexible they may be. For example, if they haven't found a house yet, they might be willing to, hang on and wait for a better offer. Find out how many viewings they've had. Have they received any other offers yet? And when you do make an offer, give them a bit of a story behind it. Let them know why you're offering what you're offering. Is there any work that needs to be done? Let them know how much you love the property. People are very proud of their homes and they really like to hear positive feedback. So also let them know that you're a first-time buyer. Sellers love first-time buyers because the sales usually go through a lot quicker as you have nothing to sell. But most importantly, know your maximum budget and try not to go above that. Vivek, if you could go on to the next bit. Thank you. So, offer accepted. Next stage is instructing a solicitor. So before you can submit the mortgage application, you'll need to get the legal side of things in place. It's more commonly referred to as conveyancing with property. So what do the solicitors do? Well, put simply, they complete all of the required legal paperwork needed to complete the transaction. They request and check required searches, so things like land registry searches, local council, drainage, environmental checks. They'll do things like draft contracts, exchange contracts, gather the funds from various sources, so your deposit, the mortgage from the lender, help to buy ISAs, lifetime ISAs, that kind of thing. They'll deal with any taxes like stamp duty tax, and they'll also register the property in your name with land registry. Now, at this point, you might be scratching your heads a little bit because there's a lot of home buying jargon, so we will be covering this in a lot more detail in future episodes. Next stage, applying for a mortgage. So now it's time to speak with your broker again, let them know the good news, let them know that you found a property, and you'll book in another appointment just to go through something called the full mortgage application. So this is where the broker will take down the details of the new property, and they will recommend to you a mortgage based on your circumstances, so the best mortgage for you. And they'll take into account things like your future plans. So the main things they'll cover are the new lender, what the monthly payments and interest rates are likely to be, any fees associated with the mortgage, the type of mortgage product. So is it a fixed mortgage, variable mortgage, discount, tracker? There's lots of different things, which we will touch on later. Mortgage terms, so again, how many years you have the mortgage over, which is usually based on things like your budget, and any associated insurances, so things like life insurance, buildings insurance, critical illness insurance, contents insurance, that kind of thing. Once the application has been submitted, we go on to point 8, which is getting a survey or valuation completed. So we touched on this a little bit earlier about how house prices seem to have gone up a little bit recently. So as the lender is securing their mortgage against the property, they will want to make sure that it is worth what you're agreeing to pay for it. And they do this by arranging something called a basic valuation. And it's really for the lender rather than you, the valuation stage. You can also arrange your own survey to make sure that the property is in good order. And there are 2 main types to choose from. So the first is something called a home buyer's report, which is suitable for things like, conventional properties less than 50 years old, just something for you, a little bit concerned, like a traffic light warning system that gives you kind of detailed information about the various different parts of the property. Or you can upgrade to something called a full structural survey. Now, this is a bit of a bad boy, and it's used for kind of older, quirkier residences, and it could be quite expensive too. So, yeah, it's worth looking into that a bit before, when you found the right property. Once the underwriting has been done, and once the lender has reviewed the property valuation, they will issue something called the mortgage offer, which is point 9. Now, this is probably one of the most exciting stages in the process because it means the mortgage has been completely agreed and you're ready to go as and when you need it, which moves quickly then on to exchange of contracts, point 10. So this is where you can relax. The property is legally going to be yours. It's legally binding. The seller can't pull out. You can't pull out. If you do, you lose your deposit. But whilst you can relax, it's also the painful time where you have to pay your deposit. So that's not quite so nice. It's also the stage where you'll start any kind of related insurances too. So if you're using a broker, they'll tend to sort out things like your life insurance, buildings insurance, contents insurance for you then. And then you'll complete your purchase. So once you've completed, you'll go to the estate agents or the developer, collect your keys and move in. So yeah, as a summary, that's kind of an overview of the whole home buying process. I've not gone too in depth because there's a lot to go through there. And I know it does look quite daunting, but bear in mind it's usually over like an 8 to 12 week period, so it is spread out. And if you do have any questions around that, we'll cover any questions that you have. But now we'll pass over to Vivek, and he can discuss how to build solid financial foundations.
Cheers, Jake. Just before that, I think we've got another question that's coming that's been tagged for live, which is
cool.
From Ben. And the question is, are shared ownership schemes offered by the government actually worthwhile, or are they junk?
Okay.
That?
Yeah, definitely. So I do quite a lot with shared ownership, really, and I think it's if you can afford to do it normally, if you can afford to buy a property without the shared ownership scheme, it's probably worthwhile doing that because you don't, you own the full property, you don't rent part of it. But it's a great way of getting onto the house, onto the property ladder initially, and it can really set you up, in the future. So no, I think if it's it generally comes down to location. So where you're looking to buy, places like London can be very, very expensive. It depends on affordability, so your income. But no, I still think it's a very, very good scheme and definitely worth looking at.
Cool. Thanks, Joe. Right, moving on to setting up solid financial foundations. So, one of the things that both Peter and Joe ran through was that, this can take a while. It can get quite efficient towards the end, but the whole process of saving up your deposit and stuff can take a while. And during that time, it's good if you are as resilient as possible. So you have, you don't have lots of things kind of knocking you off track and kind of taking you. It's almost a bit like snakes and ladders, right? You don't hit any snakes. You're just kind of going up ladders towards your end goal. And there's kind of 4 areas we tend to look at when it comes down to setting your kind of solid foundations before progressing towards any goal, basically, of which, buying your first home is the most common. And the 4 areas are around making sure you've got manageable debt, building an emergency fund, living within your means and kind of having a budget in place, and finally protecting yourself. And I'm going to run through each of these 4 sections now. So when it comes to debts, there's kind of different types of debts out there. There's kind of good debts and bad debts. And really the thing to note here are the kind of rates you pay on the debts that you take out. So a good example of a good debt would be something like your student loan. The rates historically have been quite low. I mean, I know they're kind of going up now, but you don't pay if you're not earning. There's lots of characteristics around it that make it a kind of good debt to kind of have, and you don't need to necessarily prioritize decreasing it or paying it off. Bad debts are debts that are particularly high interest. They're the sorts of types of debts which kind of lenders kind of look out for. And it can almost signal out to lenders, that there may be higher levels of risk in kind of lending a mortgage through to you. So the kind of classic examples of bad types of debt are things like payday loans, which have extremely high rates of interest, but even things like credit card debt. And actually, I was having a really interesting discussion with Joe earlier around just around the impact outstanding debts can have on how much you can borrow. And even I was quite surprised as to, with certain lenders and certain levels of income, it can quite materially decrease your kind of borrowing multiples in terms of in terms of multiples of your income. So in those cases, it can be really helpful to kind of prioritize paying off certain debts just to kind of spring up how much you can then go on to borrow. Joe, do you mind running through the kind of example we're going through?
Yeah, sure. So we did a example earlier. I just kind of picked a random high street lender just to see what kind of an impact debts, things like car finance, credit cards had, how much of an impact it had on affordability. So I did a couple with a child. One income was 25,000. The other income was 19,000. So fairly normal incomes. With a £350 a month car finance and £2,500 worth of credit card balance, which again is perfectly normal. It's not too much. It's manageable to most people. They could afford to borrow around 157,000. And if they didn't have that car on finance and didn't have the credit card, they could borrow up to 193,000. So yeah, it's a huge difference. It's not all lenders. All lenders have very, very different ways of calculating how much you can afford to borrow. But I think that goes from, 4.5 times income down to around 3 something. I think you worked out, didn't you, Vivek? I think it was, not very much at all.
4.5, 4.4 down to 3.6 in terms of the multiple.
Yeah, so it makes a big, big difference. Yeah, absolutely.
Cool. And just to, plug our Multiply app. This is something that we kind of take people through in terms of when users kind of fill in details around their existing debts, then we kind of classify them and make recommendations as to whether it's worthwhile paying certain debts off. The second area of the kind of the solid foundations and putting that together are around building an emergency fund. And I've got another poll here to launch around the question of how big your emergency fund should be. So I'm going to launch this now and give it a little bit of time for you to fill in your kind of estimates and answers for how big you think it should be.
Just while people are doing that, Vivek, I'm just wondering if we've had a similar question, Joe, regarding what do we think of the Help to Buy scheme.
Okay.
And so I think I know what you're going to say, but do you want to give your view?
Yeah, definitely. So again, it comes down to your circumstances. It comes down to where you live, it comes down to affordability, and obviously it comes down to the type of property that you're buying. So Help to Buy scheme purely now for first-time buyers and purely for new build properties. But again, it's a fantastic proposition. I mean, you know, the government loan is interest-free for 5 years, so it really can help people, and it can also increase the value of the property that you buy. So if you compare what you could potentially buy with the Help to Buy scheme in comparison to a normal purchase, the amount is usually a lot higher. So yes, it can. It's definitely a good scheme if it's used correctly. But again, it's not for everybody.
Jay, I'm gonna end the poll now. I've got some fairly interesting results, and I think we've got a lot of people here who kind of know what they're doing. So I'm going to share these results. We have no one selecting 1 week, which is great. 4%, 1 month of outgoings, nearly half 3 months, around 40%, 6 months of outgoings, and 7%, 12 months of outgoings. Now, the interesting thing is, when it comes to the emergency funds, is that it really depends on people's on people's risk levels and their kind of preferences of how much of buffer they want to build up. Our recommendations are usually 3 to 6 months. There are lots of different things that can move that higher or lower. Well, not much lower, but certainly higher. Things like being self-employed can certainly notch it higher. But also, you know, looking at what we experienced through the last year, pre-pandemic, you know, going through the pandemic that we did last year, that actually changed our views on how much people should have in their emergency fund, and actually notched it more towards 6 months rather than 3 months. In terms of potential sources, you know, we recommend that people start by building up a kind of, if they don't have an emergency fund in place, start by putting a bit of your kind of salary into a smaller emergency fund, maybe aiming for a month before kind of extending that out to 3 or 6 months. And actually, this is where we find a lot of people can get help from family. It's worth having that chat with family if they are kind of offering out help, just to make sure that they know you might be relying on them at a point in time where you have an emergency. But yeah, we find that some people kind of rely on family. And there's another point here, which is there are lenders who can look quite favorably on borrowers who have money set aside for emergencies beyond what they've saved up for their deposit. And particularly when it comes to types of properties like period properties, or older properties where there could be work to be done to the property itself, and there could be some nasty surprises as soon as people move in. Peter, you had that type of experience, didn't you? Or you've come across clients who've had that type of experience?
Yeah, exactly. Yeah, it's all I can say really is yes. Yes, it's sorry, move on, Vivek.
Cool. Well, this is over to you, Peter, in terms
Yeah,
of...
sorry, my brain had
the next
started
part.
moving on. One of the things I usually do in these sessions is leave the button on mute. I haven't done that this time, but instead I've been thinking about the next slide before actually Vivek had finished this slide before. So I apologize for that, Vivek. Right, okay, so we're going to have another quick poll question. And this is just regarding what is a budget? Essentially, this is a little area that sort of is a minor little bugbear of mine, because I see it done. It could be done a lot better by industry experts in this area. So let's start by actually just asking the question: what is a budget? I think just while we just wait for that one, Vivek, we've had another question here. I don't know if you've had a chance to read it yet, Joe, whether you want to wait until the Q&A at the end to address it, because it's a little bit out of sync with where we are, or whether you wanted to take the opportunity now.
Have a look. Is it...
It's about the buying in the southeast.
Oh, there we go. Yeah. So live in the southeast, and we'll be buying in this area due to family. It's expensive. Not a huge amount of time before the equity loan ends in March 2023. Yeah, I kind of get this quite a lot. Obviously, living in the southeast isn't the cheapest place to buy. It looks like the main issue you're having is your broker said about your income is gonna put a bit of a cap on things. Look, you've got a bit of time. Lenders will consider things like bonus that you're receiving. So yeah, use that. Try to run as much as you can in bonuses to really boost your income for affordability purposes. Lenders can also consider things like second jobs. So if you had a second job for a period of 12 months prior to buying, they can potentially use that income, as long as it's not, pushing you up towards like 70, 80 hours a week, as long as it's like plausible secondary income that you can include. That can really help with affordability. And things like, having family members go on the mortgage with you. There's things called joint borrower sole proprietor mortgages that can really help. I mean, you might not be able to use the Help to Buy loan, but it might be, another way of buying, if you can have their income involved too. And naturally, incomes kind of go up as well over the years. So you never know, your income might increase over time too. So yeah, but this is why it's always worth having a plan in place, like we're trying to do now. But if you send me an email afterwards, I'll try and get a bit more information out to you about that, a bit more specific, if that's okay.
Joe, do you think that as we come out of lockdown, that at the moment lenders are maybe being a bit extra cautious at the moment, and that things, if we were to go back to a bit more the way it was before COVID, that the lending criteria might be a bit more relaxed? Or
absolutely, yeah, absolutely. Over the last 2 years or 18 months, the difference between submitting a mortgage application then to now is worlds apart. You knew black and white what lenders would do and wouldn't do. Now there's so many grey areas, with things like people not being able to work currently, but it is getting better day by day. You can see it with things like the 5% deposits coming back. That can really help. So it's definitely going in a positive way, but I think lenders are still being cautious, especially with things like house prices increasing too. That they are looking to lend more money because of the increased property values. So it's getting better, but we're not quite to the where we were before COVID.
And I think it's probably worth saying that it's not going to make huge differences between somebody who's maybe 40, 50, 60, 70, 80,000 pounds short of their of what they need. It's more just that it's they might be able to borrow a little bit more than they might at the moment.
Yeah,
but obviously,
absolutely. These kind of 4.5 times income multiples seem to be pretty concrete. There are some lenders that are doing something a little bit different, so depending on your circumstances, they might be able to push it up to 5.5 times income. Some lenders are coming back in with things like potentially using rental from rooms that you might be able to let out to boost the mortgage amount. So there's lenders are trying, they are trying to help, you know, they really are doing what they can, but at the end of the day, they, like we said right at the beginning, lenders don't want to repossess you. They want to make sure that they can give you a mortgage and make sure that you can repay it too. So, you know, they are still being cautious.
Okay. Right, we've got some poll results in. Interesting set of responses, although I think it's fair to say that the vast majority, virtually 70% of people, are saying it's an estimate of the income and outgoings over a set period of time, which is great. And it's probably worth saying, though, that the things like a list of monthly outgoings, a list of your monthly outgoings, a review of your previous income and spending, that they are all parts of the budgeting process. But ultimately, what we're trying to get to is an estimate of your income and outgoings over a set period of time. And the key bit here being in the future. That's the key bit that we're trying to do. And the reason why I get a little bit frustrated by this sometimes is because quite often what I see are budget planners out there in the market that do 90% of the job, in the sense that they'll say, write down what your outgoings are here, 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 here. But then they don't do the last bit, which is how might that change in the next period of time? Okay, which actually leads on to the next thing, which is about over what sort of time period people should budget for. Now, people typically will budget based upon how they get paid. So if people get paid on a weekly basis, many people budget on a weekly basis. If they get paid monthly, people often budget on a monthly basis. However, what you really need to be doing is budgeting for a year, a whole year. And the reason I'm saying it's really simple, that this month, okay, I haven't had my mother's birthday. Right? Next month, I won't have her birthday again, but the month after that, I will. So what you need to do is to make sure that when you're building your budget, you're looking at all of the outgoings that can occur over the year, okay? Then, quite rightly, you should then be dividing it right back down into however you want to budget. Let's say it be monthly, okay? So that's the broad game that we're trying to do, is we're trying to look at our outgoings that we've got. We're not going to touch here how we can eke out savings. That's one of for the next session, okay? But this is very much a matter of getting to grips with your income and your outgoings as they stand today. It's one of the foundations, okay? But you're doing that over a year, dividing it back down, but importantly, adjusting things if necessary for how they might change in the future. Classic example might be car insurance. If you own a car, it might be that you need to add in an extra 5%, for example, although many have gone down this year. But in essence, that's what you're doing. And if any of your accountants out there, you will certainly know that a budget is something that is done about looking forward, and then you're holding the managers to account with those budgets moving forward. Okay, so the final bit, just with budgets, again, I could spend hours on this bit. In fact, I've done talks before on this subject alone. The key bit is that it's not a one-hit wonder. You need to keep on revisiting it. And things like open banking, for example, have really helped us get to grips with what our outgoings are. Just remember, though, that open banking is rear view mirror. It's looking back at what you did spend. You want to know what you're going to spend, because that's key to helping you save towards your deposits. Okay, so if you could just move it on the next bit. Final bit of foundations. Again, these are foundations, okay? Now, they will apply to some of you. They won't apply to everybody. There are a couple of areas that I will certainly say will apply to absolutely everybody, and it's wills, okay? It doesn't matter what happens to us in life. The one thing that is for sure, at some point, we're going to die. Let's hope it's obviously as far away as possible, but everybody should have a will. It doesn't cost huge amounts of money to get a will up and running. Yeah, you sometimes hear of solicitor prepared, very complex ones, but just getting the basics in place doesn't need to cost a lot of money. But once you've got a will, it's a big tick in the box. Lasting powers of attorney, I'm not going to go into huge detail here, but basically, A lasting power of attorney is you saying, if I wasn't capable of looking after my finances myself, or if I wasn't capable of looking after my health, okay, who you would nominate, a lasting power of attorney is who you nominate to make those decisions for you. It's a very simple way of saying it, and it's a bit more complex than that, but they are things that most people should get in place. Again, lasting powers of attorney done online, pretty straightforward process. It's just one of those ad hoc costs that nobody really wants to think about, particularly when you're younger and you're, oh, I don't need to worry about will now. Well, actually, the financial planner in me says we all should. Protection, some other times people have got may already have, say, children or dependents on other people, or other people are dependent upon you. That's where you really should be just making sure that you've got sufficient income protection in place, life cover or critical illnesses in place. But I'm not going to harp on about it. It's just signposting it for you. Okay, so you can move it on. Okay, so basically we're at the end of the first session, and I do stress first session. There's lots more to come in the other sessions, but what we have really established is gone through is buying right for you, or is buying right for you now? Two different decisions there. It might be that buying's right, but maybe I take that opportunity to save more. We've gone through what the home buying process looks like, and Joe's quite right. He's gone through it a whistle stop tour of it, and I'm sure he's done whole sessions on individual aspects of that as well. And we've gone through what the broad solid foundation should look like before we move into the real next meaty bit, which is around setting the goals and getting your plan up and running, which will come into the next session. Okay, and broadly, I mean, I think that leaves us into sort of Q&A, unless I've missed a slide. A new slide since I last saw it. Vivek, do you want to just go through those?
Yeah, so we've just finished session 1. The next session is going to be next Tuesday. That's going to be the deposit deep dive. So we're going to be running through all the kind of tips we have, which products to use, such that you can kind of build your deposit in record time. The following Tuesday, we're going to be running through mortgage success. So I've definitely noticed a lot of questions coming in through today, which are all around, how can people set themselves up to get approved when they're going through the mortgage process. The great thing is we're going to be going through all of that stuff now, whilst you're kind of for many people in the early stages of the journey. So you can kind of have a good idea of what it's going to take going forward. On Tuesday, the 22nd of June, we're going to be holding a session called Finding the One. This is going to have some great tips on the sorts of questions you need to be asking the estate agents, how to make an offer, how to really be smart about making the offer. Joe went through a couple of these tidbits earlier on today, but there's a lot more to that. And then the final session is going to be right at the end of June, and that's going to be running through sealing the deal. So what to expect after your offer is accepted, such that you can be really well prepared, and what's going to be going on in the weeks that kind of follow that point in time. Cool. So we are now going to be going into Q&A. It's taken us a little bit longer than we expected to run through the content, but we've got some time now for questions. And I've noticed we've had some fantastic questions coming through. Should we kick off with this one? So top tips on giving an offer stage of the home buying process. I know we're going to be deep diving on this at one of the latest sessions, but is there anything you want to kind of cover off now, Joe?
Yeah, sure. So at the minute, offering on properties isn't really like any other time. At the minute, it just seems to be a mad rush, and whoever's got the biggest offer generally wins. Okay, it's a bit of a weird time at the minute. Depending on where you live, depending on the property, normally what my advice is first of all, and this is true still now, get your mortgage in principle in place. Make the estate agent aware that you are in a position to proceed, okay? I touched on it a little bit earlier. Make them aware that you're a first-time buyer. It's a really, really good position to be in, like arguably better than cash buyers, because cash buyers have got no commitment to the property whatsoever. They don't pay out they don't have to have a valuation on the property. They don't have to instruct their solicitors until much further down the process, so they can pull out whenever they like. So first-time buyers, it's a great position to be in. Let the sellers know exactly what you love about the property. Try to find out from the estate agent, what encouraged them to buy it when they first bought. If they bought it 5 years ago, what did they like about the property? If you've got something in common with the current owners, it's a great position to be in. So yeah, just try to find out as much information as possible. Have a list of anything that you want to do to the property. So any changes that really do need to be made. So things like, kitchen needs to be improved, bathroom needs to be improved. That's going to cost X amount. Roof's looking a bit dodgy, anything like that. But the secret is not to insult them. If they think the house is lovely, you're going around saying that, you really don't like it, probably not going to help very much. So just have, calculated reasons as to why you're offering what you're offering. But yeah, just I'd say those are the biggest tips. But the big one is get your mortgage in principle ready first of all. That's the biggie.
Yeah, I've just got two things to add. One of them probably is more showing my age, and that is if you agree a price with a seller, it's worth asking them if they will take the property off the market. Okay. They don't legally have to. They don't have to. But it's a thing called gazumping, and gazumping is broadly where you agree a price with somebody. Okay. You think you're all going ahead, and that property's still on the market, and somebody else comes along, offers a higher price. Offers a higher price, and your so-called seller that you thought you got a deal with, they've moved to somebody else, and you've been gazumped. Now that's a little bit probably showing my age with that, but I do know from a legal perspective, they don't need to take a property off the mortgage, but it's kind of a bit of a sign of commitment. And the other bit I would just remind people about is about, as a first-time buyer and you're going to an estate agent, just remember that the estate agent is acting on behalf of the seller. And just remember that there's that. So there might be things that they may say to you. You just want to sit there and think, oh, okay, are they acting on my behalf here, or are they acting on behalf of the seller? But just remember that their contract is actually with the seller, not with you. Okay.
Just to touch on that, actually, Pete, that's a very good point. So one of the commonly asked questions by estate agents is, if you make an offer of, let's say, 250,000, but you say to the estate agent, I could go up to 260 really, but I really want to try and get it for less than that. They're then going to tell the sellers what you can go up to. They're going to say, you've got an offer at 250, but I know for a fact they're going to go to 260. So try to keep your cards close to your chest if you can, with what you're able to afford.
Great. So the next question we have is, what is a healthy percentage of your salary, combined salary, for monthly mortgage repayments?
Okay, so it depends massively on your circumstances. I mean, it really depends on what your outgoings are. Everyone's situation is different. Someone living on their own compared to a family are going to be in very different situations. So I'd need a bit more information about what your level of outgoings are, and what your kind of future plans are to really give you a true reflection on that. But what it comes down to is, like Peter says, having the budget in place and knowing realistically what you can afford to spend each month, and then working the mortgage term, around that figure. That's generally the best way of doing it, and that's generally how I give my advice. There's no point in stretching the mortgage term out for as long as possible, because the amount of interest you'll pay will be potentially more than you need to. So yeah, we just need to work in line with your budget.
Cool. Thanks for that, Joe. So the next question we have is, I'm 24, have a good deposit, started saving since the age of 16. That's very good. Well done. However, I'm buying on my own. My mum is 44, mortgage free, and has offered to add herself onto the mortgage to help me for a few years. I'll be paying for everything. However, I've heard that it's hard to get the other person off again. Is that true?
What you have to think about is there's a reason why they're going on the mortgage in the first place. So if your scenario doesn't change, then it's going to be difficult to get them off the mortgage in the future. If you're still in the same position, if you still need their income to support the mortgage, affordability, it may very well be difficult to get them off. But, if you're due to have things like pay increases that can potentially mean you can afford to buy them out and then own it, completely on your own, or potentially buy with a future partner or something like that, then that's generally the best way to get them off the mortgage.
Yeah, I'd agree. It's ultimately a lender's only going to be prepared to allow somebody to come off that mortgage if you can take it on in your own capacity.
Exactly.
Relatively simple. Okay.
So the next question we have has come from Ben. So I've seen that millennials' best option for owning a home is waiting for a parent to pass. Is this likely to change, or is it only going to get worse for younger generations given how bad income inequality is?
I think everyone's in very different situations. Some families are able to give gifted deposits and things like that. Others don't. Others have to save up. So I think when it comes down to things like affordability and being able to borrow the amount that you need to buy a property, then that's when you need to start looking at the schemes that are really built for that. So looking at things like shared ownership and using that until then in the future in a position to buy normally. But it isn't an easy time to buy. You look at years and years ago when people were buying houses for half the price. It's not income hasn't gone up in line with house value, so it is difficult. But there are schemes there to try and help.
Yeah, and at a macro level, the mortgage market has always been, not just more, the property market has always adapted to circumstances. Okay, so for example, when I first bought, shared ownerships, you didn't really get shared ownerships. They weren't around. You certainly didn't get help to buy schemes or anything like that. And that was just because at the time, buyers had salaries that could support mortgages for properties that were much lower in value. As prices have gone up, we've seen differences like the mortgage multiplier that is used. And what I mean by that, we'll cover mortgage multiplier off at another session, but what I'm basically saying is mortgage lenders have increased the amount they're prepared to lend people broadly. You've also got mortgages over longer terms than they ever used to be. So the mortgage market adapts. And similarly, if you ended up in a position where, let's say, first-time buyers just across the board couldn't get onto the market, well, I think there'll be some government intervention somewhere along the line or stimulus of something to try and change that. We've got will there be advice for self-employed in any sessions? I guess the answer to that is yes, but I'm not quite sure what level of question or what level of advice you're talking about, whether you're talking about saving for the deposit, whether you're talking about the mortgage itself, which I guess it probably is. But the answer is yes, we will be covering off the self-employed side as well. Okay.
So next
for me, I think the 70 to 80 hours. So yeah, that was in response to a question about second jobs and how we can boost affordability. I think from a lender's point of view, they have to look at a case and think it's plausible. So for the example that I mentioned, it was a case of if you have a job where you're working 40 hours a week, and then to help with affordability, to help with being able to borrow more, you get a second job, for another 30 hours or 40 hours a week on top of what you're doing. A lender's going to look at that and say, is that really plausible? Is that really going to continue? Can we really base our 30-year mortgage term on someone working that many hours a week? If your main job already consists of you working, if you're self-employed, for example, or your job, you're able to do it, then it's a little bit different. But if you're doing it solely for the purpose of mortgage affordability and just getting a second mortgage, that it really does need to be a little bit plausible. That's all.
Okay. If planning to relocate, is it possible to get mortgage sorted before moving in current job? Joe, again, this is very much a mortgage specific question.
Yeah, that's okay.
There's an answer that a financial advisor would give, I think, here, and it might be subtly different to what a mortgage broker might say. So I'm interested in what you're going to say.
Yeah, definitely. I mean, really, all I can go on is previous mortgage applications where I've had this kind of scenario before. And again, although you may be in a position to afford the mortgage at this point in time, it's not a mortgage on day one. It's not just based on that. It's based on the entirety of the mortgage term, the 25, 30 years. So what they would want to see is potentially a contract of employment from your new job saying that you're going to be starting on such and such a date. If you haven't got something else lined up, what they'll likely do is take into things like, commuting time into account if you're able to work where you currently work and still commute and things like that. Or if you'll need to rent until you find a new job, they'll take into account the rental outgoings that you'll then have. So ideally, it would be good if you had something lined up. And if you do, then yeah, that wouldn't be an issue at all.
Yeah, and the bit that I would add there is that if the scenario was that you couldn't then afford it in the new circumstances and you knew that, then under most mortgage contracts, there is a clause there that you have a duty to tell a lender of a material change like that, certainly before a mortgage has been offered. Okay, if you have a few items on credit, such as sofa mattresses and a phone via monthly payments through Apple, do these affect massively? Again, I don't want to detract too much away from how the mortgage side works, but the short answer is, do they affect it? Yes. That's the short answer. They do. The extent, well, that's probably going to be dependent upon the percentage of your total income that these debts are linked to. So obviously, if you've got 100, if they all totaled £100 a month, and you had a salary of £100,000 a year, then in theory it's relatively small. Okay, but if that was £500 a month and your salary was £25,000 a year, then it's going to have a much bigger impact. The answer, the question you asked actually was, should I pay it off? And the answer to there is, if you can, yes. That would be what I would say. Because any financial advisor broadly works on a basis that if you can avoid having debt, then that's great. But we're all realists and understand that most people haven't got capital, so therefore to buy a house outright. So therefore, a mortgage is a debt. It's what Vivek was talking about earlier about having a good debt. That's a good debt. When we say good debt, bad debt, we didn't necessarily mean bad debt as in you're not meeting your payments. It's the type of debt, whether it's a debt that you really shouldn't have, for example, a payday loan, something like that. Okay, but the answer there is, if you can pay it off, that's what I would be doing. Okay. I've got a 10% mortgage saved along with some more for renovations, but would it be advisable to save a bit more and get a 15% mortgage, perhaps at the expense of any additional budget for renovation? It's, I believe the answer to this is going to lie in the mortgages, so it's going to be Joe again.
Yeah, that's fine. So my advice is always, the bigger the deposit you can put down, the better. You're going to have access to better mortgage products. The lenders, it's less risk from their point of view. So the more you can put down, the better. But it depends on the type of property that you want to buy. For example, if it is something that needs renovation, then likelihood is the property value is going to be a little bit less than properties that are already done up. So it's all relative. But yeah, the bigger deposit you can put down, definitely the better.
On to our final question now. So do you think there is likely to be further schemes after Help to Buy, given the current situation and demand by first-time buyers?
Yeah. I do. There's something called the Fast Home Scheme that should be coming out towards the end of this month now, I believe. And until there's more information about it, I'm not going to give you, too much information because I don't want any of it to be wrong. But that looks like quite an interesting scheme, quite a new one that's coming available. So by the time we get onto the actual mortgage webinar, hopefully we should be able to go into a bit more detail about that one.
Fantastic. Great. So I think that marks, I think we've got one final question that's just come in from Anna. So would having a record of the company I work for, giving annual bonuses around 10% and annual pay rises 9.2% this year, as well as the fact I've had a pay rise for promotion every year for the last 3 years, be beneficial for the mortgage application? In contrast, would the fact my partner has had fluctuating pay over the last 5 years negatively impact the application?
Right. Would you mind if I answered this? Because this scenario was pretty much exactly the scenario I had back in 1994 when I bought. Okay. Yeah. And the answer laid into it, would it be beneficial to have it? The answer was yes. Would it be negatively impact? And the answer was yes as well. It was, but in my situation, they were borderline. So they were making the computer said no, shall we say? They put my data in, and this was because I changed to a job that had become, a lot of it had become commission based. The role that I'd moved to, and the computer said no, but the computer was saying, but it's nearly yes. And me having a letter from the employer that actually had this potential history helped them make a decision. It didn't say to them that, oh, because you've got a letter, yes, it does, there's, it always will, but they took it on balance. In other words, it wasn't just a computer generated decision. That was back in 1994. I'm interested again to see what Joe is seeing now in 2020, 2021.
Oh, it's completely different now, completely different. No, I'm joking. It's pretty much exactly the same. It's exactly the same. So what they'll do is they will, they'll basically go off whatever your contract says. So, if your income has gone up and up and up, they'll look at the most recent contract and they will use that for affordability purposes. But also in line with that, if you've got a contract, if you're due for a pay rise, within a sensible period, so 3 to potentially 6 months, if your employer can provide you with a letter saying when your pay is going to be going up, they can potentially use that income for affordability purposes. So that can actually help you borrow more. You mentioned your partner having kind of fluctuating income. It depends. If he's employed, again, exactly the same applies, whatever the current contract says. If he's self-employed, it's a little bit different. Lenders are very fussy with self-employed people at the minute just because of the whole COVID thing. They're really, really, really fussy. So it will depend on things like whether they've taken any grants or anything like that. But what they'll generally do is, if pay has been going down, they'll only use the most recent income for affordability purposes. Whereas if it's been going up, they might take an average. So yeah, hopefully that helps.
Cool. Well, on that note, it's a wrap. I want to thank everyone for attending and bearing with us because we overran a little bit. And we're going to be sending out invites for the upcoming events. The next one, next Tuesday, in the coming days. So keep a lookout for that and hope to see you then. Thank you, everyone.
Yep. Thank you.
Thanks. Bye.